Hey, Freedom Fighters. Rob Berger here, author of Retire Before Mom and Dad. Today I want to talk to you about Warren Buffett and Berkshire Hathaway. I've been a long-time investor in Berkshire Hathaway, going back, I'd say about 10 years. Been to a couple of meetings, took my family there. If you've never been, highly recommend it. But today we're going to talk about some news that's come out that kind of suggests maybe Warren Buffett's lost it. Maybe he's lost the Midas touch. He was a great investor, but now maybe he's a has-been. It's funny, this isn't the first time folks have made this claim. And so far, all of the ones that have kind of claimed that Warren Buffett is washed up, he doesn't understand technology, he doesn't understand the 21st century, they've all been sort of proven to be incorrect, I suppose you could say. So today I want to look at sort of the new claims. They actually can teach us some very important lessons about investing, even if you don't ever invest in Berkshire Hathaway. In fact, there are four really important lessons that we're going to talk about today. But let's begin. I'm showing you here an article from Business Insider that talks about not just his underperformance, it's chronic. According to Business Insider, some investors and analysts are frustrated with his chronic underperformance. And in fact, one of the examples they give, and you can see it right here, they say that last year in 2019, Berkshire stock rose just 11%, while the S&P 500 gained 29%. That was sort of one of the examples of his chronic underperformance. There's another article, this one on MarketWatch. This was Howard Gold, and he actually, I think, takes it a step further. He says, dud stock picks, bad industry bets, vast underperformance. It's not just chronic, now it's vast. It's here, it's there, I guess it's everywhere. It's the end of the Warren Buffett era. Now, that's the claim. We're going to try to understand why they believe that, if their views on this are justified. But before we do, we should, I think, try to quantify this underperformance that everyone's talking about. Is it just 1 year, 2019, underperformed, so that's it? It's done? Well, no. Howard Gold goes much further. He actually looks back. You can see it here. He says that he's underperformed. He calls it profoundly. So it's chronic, it's vast, now it's profound. You can probably get a sense with my sarcasm what I think about these claims. But in any event, he claims that the underperformance, it's profound, and that in the entire 11-year bull market, he underperformed the S&P 500. And so, as always, when I see a claim like this, step one is to make sure we get the facts right. And that actually brings us to the first lesson, is that, when someone throws out some details like this, you want to kind of step back and say, well, wait a minute. First, is the data correct? And let's assume that it is for our purposes. But also, are we looking at it the right way? For example, in this article, they look at an 11-year period, and they say, okay, based on that 11-year period, Warren Buffett's underperformed the S&P 500. So number one, is it true? And number two, does it make sense? Why are we looking at the last 11 years? Why not the last, 10? If we lop off a year, does that change the results? Or what if we don't start in 2009 in the bull market? Maybe we go back to 2007, because that would give us an idea of performance through both bad markets and good. Maybe that would give us a more complete picture. Or who knows, maybe that doesn't change anything. Maybe his underperformance is as chronic and as vast and as profound, regardless of how you look at it. Well, I did the math. Let me show you a spreadsheet I put together. Here it is. And it's 3 sections. This first section is tracking what Howard Gold told us in his MarketWatch article. And sure enough, just so you understand what we're looking at, this column B is the performance of Berkshire Hathaway by year. Column D is the S&P 500. And let me show you where I got these numbers. I actually got these numbers from Warren Buffett. He puts these out every year in his letter to shareholders. Let me show you that. Here is the last letter, 2019, and this is actually page 1. He shows the market value of Berkshire, and he compares it to the S&P 500 with dividends included. And I started, as Howard Gold did, in 2009, which is right here, and I went all the way down through 2019. There are the numbers, popped them into a spreadsheet, and actually it's interesting. Berkshire actually outperforms the S&P 500 in more years, actually 7 of the 11 years. But of course, it underperforms, and it's not just how many years you outperform or underperform, it's by how much. And when you do the math, sure enough, Berkshire lagged the S&P. The compound annual growth rate for Berkshire was just over 12%, and it was almost 14.7% for the S&P. And when you put that in numbers, $10,000 investment, it's a pretty big deal. It may not seem like much, 2.5%, but a $10,000 investment in Berkshire comes out to about 35 grand at the end of that period, and it's 45 grand if you basically put your money in an S&P 500 index fund. So maybe they're all right. Maybe this has been terrible performance. But then I thought, as I mentioned, well, what happens if you lop a year off? We just look at the last decade, and that's what I did here. Turns out he still underperformed the S&P 500, although not by nearly as much, about 50 basis points. So I'm not sure if you would call that vast, profound, or not. I don't think so, but it's still an underperformance, fair enough. But then when I looked and I went back to 2007, I started there, and the thought was, that gives me like a full cycle. We get both the bear market, the terrible market crash, 07, 08, and 09, and then the bull market. This will sort of give us a complete picture. Here, well, Berkshire turns things around. They actually outperform the S&P 500. Again, not by much. Compound annual growth rate of just over 9% for Berkshire compared to 8.82% for the S&P 500. But here's the real point. Maybe the claims of vast, profound underperformance are a bit exaggerated. The real point is, when people are throwing data at you like this in numbers, even if the math is correct, always question the underlying assumptions. Why did they pick that time period for comparison is always a big issue. You can cherry pick the time period to get whatever result you want often. And it's important to understand that. But having said that, he did trail the S&P 500 last year by a significant margin. And it's worth maybe trying to understand why. And actually, if we drop back to the MarketWatch article, Howard Gold sort of walks through his concerns, I guess you'll call them, with Warren Buffett and his investing. And there are 3 of them. And I'm going to scroll down here so you can see them. I think it was in this article. Maybe it wasn't. Well, that's okay. I've got it. He mentioned it in another article, but I've got it here. This is actually an article I wrote that will be published as part of this video on robberger.com. I actually write my articles now in Notion, by the way, which is a great free app that I use to track a lot of data. So I highly recommend it. And there are 3 investments that folks have been complaining about, I guess you will. The first were the airlines. You can see it here. At one point, Berkshire bought in about $7 to $8 billion worth of airline stocks, 4 main airlines, Delta, American, Southwest, and United. Frankly, it was a surprise to me when they did this. Buffett has not had a good history with investments in airlines, and they're not really his kind of investment, at least from my perspective. They're very capital intensive. It's extremely competitive. He talks about having a wide moat around a business. I mean, there are moat-like aspects, if you will, to the airline industry, kind of, mainly in routes, I suppose. But by and large, not a wide moat industry, a business, and very capital intensive. You got to put a lot of material up in the air to get a jet airliner from point A to point B, and you got to pay a lot of people. Very expensive. So frankly, I was surprised when he invested in these airlines. At the time, my assumption was he thought that the valuations justified the investment. Maybe they did. The problem, and one could argue this isn't Warren Buffett's fault, but COVID happened. And that did 2 things. It, of course, decimated the demand for air travel, as we all know. And sure, it's presumably temporary, but it's not as if you're going to flip a switch and everyone's going to be flying again. After 9/11, I've read that it took about 2 years for the airline industry to get back to where it was before 9/11. Who knows how long it'll take after COVID. Again, no one could have predicted this, but nevertheless, COVID happened and the demand just dried up. And as part of that, then, that triggered the second thing, and that is these airlines have to raise a lot of money. And how are they going to do that? Well, they're either going to borrow or they're going to issue more shares. Either is bad for current investors. If they borrow, that's just debt they've got to repay out of future earnings. So that's not good. And of course, if they issue more shares, it dilutes the value of the shares held by existing shareholders. And so Warren Buffett and Berkshire exited out of all of these investments, and obviously at a loss. Some put it at about $5 billion. I can't verify that number, but I think we can all agree it didn't turn out to be a great investment. So that was the first one, and the most recent, really. But there were two others. Kraft Heinz has obviously not gone well for Berkshire Hathaway. And there was actually an interesting Harvard Business Review article on why they were really focused on cost cutting. And at least Harvard Business Review felt that they didn't do a good job of managing people, that is their employees, during that time. And it kind of, as a result, innovation was hurt at the company. Whatever the reason is, some put his current loss at $2 billion on that investment. Again, I can't verify those numbers, but we do know that he's lost money on it, or Berkshire Hathaway has. The story's not over. It's not, the company's still there, and we'll see what the future holds. But it's obviously been a lot harder than I think certainly Warren Buffett would have hoped for. And then finally, Occidental. This one's a little more interesting. He bought preferred shares. I think it paid an 8% dividend, I think was the number. Frankly, a phenomenal deal for Berkshire. But once again, they did an acquisition that loaded them up with debt. And then you have COVID, which brought the energy industry to its knees. When people aren't flying and they're not driving, and industry is all but shut down, well, people aren't burning oil. They're not using certain commodities, and so of course the price of oil is tanked, and that's obviously hurt Occidental. It'll be interesting though, I think, to follow that story over time. I still think it's quite possible that could turn out to be a phenomenal investment for Berkshire, but then again, I just may be showing my own ignorance. The point is, those were three investments that have obviously not gone well for Berkshire. And so for those that want to spin a narrative that Warren has lost his touch, those are the investments that they focus on. So what's the lesson here? Well, the lesson is make sure you get all of the facts. Yes, you can focus on some bad investments. And by the way, Warren Buffett will happily tell you about other bad investments that he's made. He's not shy about doing that. But what it ignores is some of the great investments he has made and that Berkshire has made. One of them, I think, probably the most notable in recent times, is actually Apple stock. They have made a fortune in their investment in Apple. And in fact, I read recently that it represents about 90 billion, or almost like 25% of the market value of Berkshire Hathaway. I mean, I think it's just, the number has just gone through the roof as the price of Apple shares has gone up. So you really want to make sure you get all of the facts. Yes, you can point to bad investments, and you should. These are worth, considering and evaluating and trying to understand what went wrong, right? But you can't stop there. You need to look at the good and the bad, or the bad and the good, depending on how you want to look at it. And I think those that are trying to spin a certain narrative tend to only focus on the difficult investments and totally ignore the positive ones, including, by the way, companies that Berkshire owns outright that are still just generating cash quarter after quarter after quarter. So lesson 2 is, sure, listen to the naysayers, but make sure you get all of the facts. Now, the third one, and this is probably the most interesting for me, and they're kind of related, but there's been this complaint that Berkshire's holding too much cash. It's got about 140 billion. And to that point, there's also been real concern that during the coronavirus crash, if you will, when we entered a bear market, that Warren Buffett didn't gobble up a bunch of stocks. In fact, James Shanahan, he's an analyst at Edward Jones, says, quote, "I am nervous that he may have missed this whole rally. That's frustrating. A lot of retail investors were plowing money into the market and doing better than professional investors." And Ken Fisher, billionaire investor Ken Fisher, actually said, look, I think he didn't take advantage of the sell-off because he's getting old. And he is getting old. I think he's going to be 90 in August, and his business partner, Charlie Munger, I think is 96. That's pretty old, I think, by anyone's standards. But what really surprises me is just how, and this is going to sound maybe too harsh, how shallow the analysis is. I'm really surprised, particularly at Ken Fisher, because I think he should know better. I don't know who James Shanahan is, but Ken Fisher should know better. This idea that the coronavirus sell-off was something that investors should jump on is kind of silly, and it gets us to lesson 3. Don't confuse price movement with value. Just because the price of something, whether it's an index like the S&P 500 or an individual stock, drops by, let's say, 30%, I think it was 32% in the case of the S&P 500, doesn't mean it's a great buy. It still may be overvalued. Sure, we can say that it's a better buy than before it dropped. I guess that's true. But just because something's gone down by 30% doesn't make it a deal or a steal. In fact, if we look at the PE ratio, and I'm going to pull it up now, this is from the Case-Shiller site, although this is not the Case-Shiller PE. This is just your current S&P 500 PE ratio. As you can see, it stands at 22.11. Now, I think some could argue that given low interest rates, that PE is to be expected. You expect asset values to go up as interest rates go down. But from an historical perspective, it's still pretty high. Now, some would say, well, but Rob, the market's come back up since the coronavirus sell-off. Well, it has. Then it came back down a little bit. But even at its low, it was the PE was still like 21 or thereabouts, certainly above 20. And so, yeah, the market didn't get cheap. It got cheaper, I suppose, but not exactly cheap. And here's the thing. Warren Buffett doesn't give a hoot what the price was a month ago or that it's fallen by 30%. I mean, he's going to evaluate an investment based on what he thinks the intrinsic value of that investment is. The fact that its price has fallen by 30% doesn't automatically make it, that's my own word, by the way, make it a good investment. These folks that are focused on the price movement are fooling themselves. And Warren Buffett knows that. Certainly, if a price falls by 30% and as a result, in his mind, it's a great deal, sure, he may very well buy it. But just because the market has fallen by 30% doesn't mean that it's on sale now. It just means it was cheaper than it was yesterday. Not a bad thing, but again, not a sale. And that's really important to understand. Whenever the market goes down quickly, I always hear people say it's a buying opportunity. Well, it might be, may not be. Just because it's fallen doesn't mean it's a good deal. So that's an important lesson to keep in mind. And that brings me to the fourth lesson, and it's this. We don't know the future of Berkshire Hathaway, right? It could be that it underperforms the S&P 500 over the next 5, 10, 15, 50 years. And in fact, Warren Buffett has said, look, we have so much capital. It's really hard to beat the S&P 500. He can't make a small investment. A $10 billion investment for Berkshire is nothing. It's not going to move the needle. He needs really big investments to move the needle, and it's really hard to find really big investments on a fire sale. And so he's acknowledged that it will be difficult to beat the S&P 500, but it gives us some insight really into actively managed investments. So that would be an actively managed mutual fund, individual stocks, anything other than what you might think of as an index mutual fund. And here it is. If you take an active approach, there are going to be times when, even if it turns out over time to be a phenomenal investment, that it significantly underperforms the indexes. That's just a given. And in fact, let me show you here in this article that I wrote. I took some data from the Berkshire Hathaway annual shareholders letter. Look at this. In 1974, Berkshire lost 48.7% compared to the S&P 500 of just losing 26.4%. Still a bad year for the market, but my goodness, Berkshire almost doubled the loss. What about 1990? It lost 23%. The S&P was only down 3%. And 1999 is really ugly. Remember, this is right before the tech bubble burst. Berkshire lost 23%. The S&P 500 was up 21%. So here's the thing. We know that Berkshire Hathaway over the long term has been a phenomenal investment. In fact, look at this. We'll pull up his newsletter again. Since 1965, look at this right here. The S&P 500 is up 19,000%. Berkshire is up 2.7 million%. That's a big difference. Yet you can zero in on some years like I did here, and it looks really bad. And it raises the question, if you were a Berkshire shareholder owner in 74, would you have lost faith? How about in 90? How about in 1999? Or how about today? Ken Fisher's apparently lost faith in Warren Buffett. So has Howard Gold. They've lost faith. Are they right? Well, we don't know. But here's the thing, and it gets us to lesson 4. Choose an investment strategy you can stick to even in bad years. And let me correct my typo. There we go. We need an investment strategy that we can stick to even in bad years. And I think for a lot of folks, investing in individual stocks, it's very difficult to stick to investments when they're significantly underperforming the market. We can certainly look back, say, for example, at Berkshire and say, oh, we would have stuck it out. But of course, we already know how that story ended, or at least so far. It's easy to look back at 74 or 90 or 99 and say, oh, yeah, we would have stuck it out. But, well, would we? Well, I guess that's only a question you can answer. I think that's one of the reasons, maybe one of the biggest reasons I favor index funds, is that I think they enable me to stick out bad markets. And keep in mind, there are times when there are more actively managed funds that outperform the index. That's usually in a bear market, but it does happen. So you could be asking this very question even as an index fund investor, because there could be a year or two or whatever where there are a lot of actively managed mutual funds outperforming the index. And of course, you know what's going to happen when that occurs. All of the internet financial sites are going to be writing about it. It's going to be on the cover of magazines, if anyone reads magazines anymore. It's going to be on the news, and you're going to feel like an idiot. Okay, well, maybe you won't feel like an idiot. Maybe I'll feel like an idiot. And it's then that we have to say, okay, what's our investment strategy? Why did we pick it? Are we in for the long haul, and are we willing to stick to it? And I think whatever investment strategy you ultimately pick for yourself. For me, it's primarily passive low-cost index mutual funds. I do own Berkshire. I do own Apple, but it's 85% index funds. That's a strategy I know I can stick with, even if there are going to be some years here and there where there are some notable cases with actively managed funds outperforming the index. Happened with Berkshire too. Those investors that have stuck with Berkshire since the 60s and 70s had to live through some years where people were really questioning Berkshire Hathaway and Warren Buffett like they are now. And of course, in the long run, it's paid off for them handsomely. Well, there you go. As you can tell, I don't think even at 90, Warren Buffett has lost it. And I don't at all think that there's any issues with him not buying the coronavirus bear market. I think that would have been a terrible mistake. If he finds individual investments that he thinks are good investments, he'll put Berkshire capital to work in those investments. But he's not going to run off and throw money at investments simply because the stock market is down by 30%. Well, there you go. Hey, listen, if you have any questions, leave them in the comments below this video and feel free to shoot me an email, rob@robberger.com. And until next time, remember, the best thing money can buy is financial freedom.